Today's Animal Spirits is brought to you by YCharts. After a decade of near zero rates, bonds are back in the spotlight, which means clients are asking tougher questions. Is credit risk rising? How do ladders compare to funds? Are my income strategies still holding up?
That's why YCharts just rolled out bond-level data on more than 6 million securities integrated right into the same platform top advisors already use for equities, funds, and proposals. With this update, you can quickly spot credit and duration risk, illustrate ladders versus funds with client-ready visuals, and deliver proposals that show the full portfolio picture, not just the equity sleeve.
This is cool. A lot of advisors love the individual bond securities, so do clients. So tons of advisors are already taking advantage of this data. So check it out for yourself today and get 20% off your initial YCharts professional subscription when you start your free YCharts trial through Animal Spirits, new customers only. Welcome to Animal Spirits with Michael and Ben. Michael, I told you, I know you didn't want to talk about the AI bubble anymore, but I want to talk more about sentiment in general.
Hold on, you're putting charts into my doc. I never said that. I never said I don't want to talk about the AI thing anymore. I merely said I feel like it's all we're talking about. Can't avoid it.
Oh, okay. 2 weeks ago, you said you wanted to do an entire episode with no AI talk, remember?
Impossible.
Do you forget this
Failed.
already?
Failed.
All right. So I want to talk about the difficulty in gauging sentiment these days. So Bloomberg has this chart, and they show that the S&P has gone nearly 100 days without a 5% pullback. And the average is around 97. So we're right about there, which is kind of crazy. It's been that long. And this whole article was about like, hey, listen, turbulence ahead. Expect more volatility. We haven't had this 5% correction. It's coming. And they did. Do you look at these AI takeaways from all these articles now? It's like
Nope.
the very top of
Nope.
every article now.
Nope.
Wall Street Journal, Bloomberg, AI takeaways.
Nope. I
I
still read the articles manually.
Okay. The whole thing is just talking about how like stocks are due for a pullback. It's, my wife is still a Today Show watcher. Which one does your wife watch? Because
Good Morning America.
good, yeah. So everyone has their one. My wife she doesn't even watch it really. It's just on in the background, okay? And she had it on I think this was Sunday morning, and they had a whole expose piece. Willie Geist talking about, are we in an AI bubble? I did a little screenshot here of my TV. It's weird because on the one hand you'd say, listen, no bubble in history has ever had so many people call it in advance. But I think you could also say no bubble in history has ever had this many people that are giving opinions all the time. So I'm listening to, not reading, the 1929 book by Andrew Ross Sorkin. Is that one on your list?
I'm going to do it the old-fashioned way. I'm going to read it.
Okay. Way too long. How many pages is it? It's way too long for me to read, so I had to listen to it.
Credit to him. I didn't even look at the back yet until just now. Yeah. He's got Ron Chernow, Walter Isaacson, Beverly Gage, and John Meacham writing reviews. That's the Mount Rushmore of reviewers.
Okay, that makes sense because this feels like a biography in the sense that there could have been some stuff in the cutting room floor. Okay, no offense. That's how I feel about all biographies, right? But it's a story, and I'm a huge fan of reading about the Great Depression. Like, it's weird. It'd be weird to say I'm a fan of the Great Depression, because that's obviously a really bad time in the history of our country. But it's way more stories and anecdotes than I ever thought before. But there's a really in ton of good characters, and there's some that it's like some that's a little too much. But then you hear these anecdotes and stories you never heard before. So he has a whole chapter on Jesse Livermore, which is excellent, and he talks about how there was this story in the New York Times in 1929 called "The Magnet of Dancing Stock Prices," and I actually found this. I think you showed me this. The New York Times has their archive, right? So I pulled up the actual story, and it's funny because a lot of it does, and people keep asking Sorkin about like, does this time period kind of make you feel like the 1929 peak a little bit? And so this is from the article. Despite setbacks, the broker's wires again become clogged with orders for stocks from all parts of the country. Tips fly about freely. Violent advances and declines in leading issues are a daily occurrence. This is the best part that reminds me of today. It is quite true that the people who know the least about the stock market have made the most money out of it in the last few months. And Jesse Livermore stepped in and he essentially said, I'm using this as a contrarian indicator. All the amateurs are making way more money than the pros. I'm shorting the market. And he made like
$100 million, I think, in $1929.
And he made a ton of money. And this isn't a quote from the article that I've never heard before. He said, stocks could be beat, but no one can beat the stock market. So that was a really good. I've never heard that one before. It's really, really good. So anyway, it talks about how he used this, and he used this sentiment shift to short the stock market and made a ton of money.
Can I ask you a question? You think Livermore was a there he is, or was he a that guy?
Well, they said he really liked to show off his apartments and his cars and his nice clothes, and so
All
He
right, so he
wanted to
might have
be
been
a,
he might have been a this guy.
yeah, he wanted to be a, oh, there he is, one of those guys. But anyway, my whole thinking is I don't think that you can use these indicators as well anymore as you did in the past because there's just so much of it everywhere. It was very confined in the past. It wouldn't be shoved in your face all the time.
I'm glad to hear you mention that because I feel like the noise of the sentiment that's I've been on that corner for a while now, and you could look at 10 different pieces of information, data, and make 10 different conclusions. Now, of course, the best is to just make a composite, but even then, which investors are you talking about? I've said this a million times. Are you looking at Schwab investors? Because their S-Tax report paints a much different picture than what you're seeing on Reddit or Wall Street Bets or the Robinhood type of young, like, so, and then to the point about the media covers the stories, and the bigger the story, the better their ratings. And so they are dying for a bust, right? Like that would be
Oh yeah,
that would be a great story. So I think you're 100% right. It's very difficult to talk about indicators the way that we used to, because how many over the last decade could we point to? Now, listen, once in a while they work, obviously, right? Like they don't all not work.
right,
But I keep coming back to Jensen Huang signing a bra and the NVIDIA watch party. Was that 2 years ago at this point?
right.
Now,
There's so many instances like yeah,
if you zoom out and this does become an 80% washout, which I very much don't think is going to happen. But if that were to happen in the future, 50 years from now, people are reading about it today. Well, does it matter if these indicators were 24 months early in the grand scheme of things?
yeah. But to your point about the financial media, I've made the point that the financial media was cheerleaders for the dot-com bubble, and no one in the financial media called the 2008 crisis.
Well, they
Like they
learned their
were all
lesson.
caught
They
flat-footed.
don't. They
So
don't want to. They don't want to be embarrassed again.
yeah. So the fact that the financial media is more negative about everything going on, right? And pointing out all the risks all the time, there's a reason for that. That's learned from past behavior. Um, but I think it's funny though because you see, so right now the worry is what regional banks and BDCs and maybe private credit and there's so many of these worries. I put this chart in here about the 10-year Treasury yield back under 4%. Remember 3 months ago when
I
people
sure
thought
do.
Treasuries are at 5%. That means we're imposing fiscal discipline and bond vigilantes. And here we go. Inflation is taking off. And I think all these little things people worry about, I think it's worth reminding people that the majority of them just kind of fall by the wayside and people forget, like, oh, remember when we were worried about that? Doesn't matter anymore.
Well, that's got to be your default position for most things. Now, it doesn't mean that you're being complacent and you're not worried about risk, because
Right.
as investors, risk should be first, and return should be who cares? They'll take care of themselves. So you have to be disciplined, and it's not to be oh nothing matters, but it's okay. How about this? If there's two extremes, everything matters and nothing matters. Probably nothing matters is the better default position. And that's where I landed on this BDC stuff. I've been doing a lot of reading on it, and the truth is, we're all guessing. Nobody knows. Nobody knows where the cockroaches are. Nobody's reading the loan documents. I know as much as everybody else. I read the same
How
shit.
about this? Sometimes there is only one cockroach. Sometimes it is your first rodeo. And sometimes you haven't seen the movie yet and you don't know how it ends.
Right?
How's
Yeah, I
that?
love it, Ben. But my default position with this is, yeah, there's some bad behavior going on, and there's some bad loans being made. I've no doubt about it. There's no doubt about it. There's too much money coming to the space. People are lackadaisical. I have no doubt about it. But does that mean that this is systemic risk that is going to take down the financial system and BDCs are the canary in the coal mine? Maybe it could happen, right? We'll see. But that can't be your default case unless you really know something that everybody else doesn't. Unless you
That's what
really know.
I'm sick of people warning me about systemic risks. Like I'm at the show me point of stop telling me this could lead to something down the line. Show me when it does. That's where I am at because everything that people have warned us about, none of it has mattered. Right? None
Well,
of it.
most of it.
All right. Speaking of hedging systemic risks, I wrote a blog post about why I don't own any gold. And it's a tough position to be in because so here's our friend Med
Yeah,
Faber.
I would not be pounded the table on why we don't own gold. Like it's, gold is kicking ass.
I'm not pounding the table. I want to explain myself. So Meb Faber says, listen to his tweet. Gonna be a lot of uncomfortable conversations at year end when people ask why their portfolio manager or advisor doesn't own any gold. Been a menace this year. So I thought like perfect time to explain the reasons behind why I personally don't own any.
Well, we don't
And
own
I
gold.
think,
We don't own gold for clients, and there's people that are asking about it.
yeah,
How
people are
could they
certainly
not?
asking
Because
about it.
gold is a headline asset.
Yes, it is. When it's doing well or when it's not doing well. Here's the thing though, like when Meb says there's gonna be a lot of uncomfortable conversations, you could say that every single year about any single asset class. Why don't we own Bitcoin? Why don't we own biotech stocks? Why don't we own
But gold is a different beast than all of those things. Gold is not biotech stocks. Because gold is when gold is flashing on the front pages of the paper of USA Today, it gives potentially uncomfortable feelings about the system, about the
Yeah.
dollar, about confidence in the economy, in the political system. Like it is its own beast. And people don't ask about biotech stocks or any other asset class the way that they ask about gold.
Yeah. And I heard from there was some crazy gold people who gave me the business a little bit on this. And it's funny because the real true gold bugs, it's funny, even when gold is working, they're not happy. Right? They're not because it's like, of course, the system hasn't failed yet. Like they want the system to fail. That's the only time they're gonna be happy. But there's a lot of people who wrote me and said, listen, I put 5 to 10% in gold as an insurance. A lot of people use the word insurance for me, for why they own gold. And I thought that's a completely fair
Mhm.
reason. It's a hedge, it's an insurance, it's the dollar falling, it's all this stuff.
All valid.
And I get it. And gold is one of the most unique asset classes that there is. It really does march to its own beat. And I think so like the case, I tried to paint a nuanced picture here. Like I totally understand the case for owning gold. I
I
just
mean,
personally
I do think last week you were a bit harsh on this podcast, saying that like none of what they said came true. Like it felt like it felt beneath you. You're punching people when they're winning. It didn't feel great.
Okay, I listen. It's
I
more the
listen.
charts than anything.
No,
The chart. I was
I know where you,
prosecuting a chart crime.
I know where you're coming from. You're thinking like, oh, the dollar is going to blow up and the system's going to melt down, and therefore gold
Yeah.
is going to be your savior. I know what you were saying, but in a vacuum, it felt harsh.
I am an optimistic person and I'm anti-doomerism. So that maybe that's where I'm coming from is that I don't like the people who are constantly trying to use scare tactics. And so that's why
Same
I think
page, of course.
those chart crimes and stuff just kind of are. But listen, the people who own 5, 10, 15% or 20% in gold or whatever, obviously they don't think the system's going to fall. It's a diversification, volatility, rebalancing. So that piece makes sense to me. Obviously, like I get that from a portfolio manager perspective. Here, let me just walk through why I don't my personal opinion on it. So I did this thing in my post where I looked at the return history of gold. And gold went crazy in the 70s, mainly because Nixon ended the peg to gold with a dollar, right? So it was up like 1,400%. So that it's a huge, and it was playing catch up because it was pegged all those years,
I feel like
right?
that whole period, the bubble and the aftermath, sort of has to be removed from history because it is a
Yes.
true one of one, will never happen again. So it's almost like irrelevant a little bit. Now I know it also coincided with inflation, and so that's part of the
Right.
story. So you can't do
Yeah.
that part
And
of it. But
oil
like that,
price shocks.
right?
And so, but my point is if you look at gold in the 80s, 90s, 2000s, and 2010s, you had 3 out of 4 decades where gold was in a lost decade. So in the 80s and 90s, gold, and obviously part of that was the overhang from the 70s. Um, but that whole period, I'll be honest, that whole 3 out of 4 decades of having a lost decade and going nowhere. Um, Now you could say I'm cherry picking because if you start in 2000, hey,
Right.
gold looks pretty good. If you start
Yeah.
in 2020, like there's time periods where gold does look better. I just that whole period of multiple decades in a row where you go nowhere. And now some other people said, listen, you're comparing gold to stocks. That's the wrong comparison. Compare gold to bonds. And if you look at the long history, like Demoterin has the return history going back to 1928 for gold, and actually gold returns going back that long are closer to bond returns actually. Um, and obviously, some people would say, "Well, why do we have to choose? I could do gold, and I
You
could do
don't.
bonds, and I could
Yeah,
do
you can do
stocks."
both.
And you don't. So, and I'll be honest, I was wrong about this. I kind of thought Bitcoin would take the shine, pun intended, off of gold a little bit. So it surprises me that Bitcoin didn't knock gold down a peg. Because I'm more of I guess, a techno optimist. Um, and I would have thought Bitcoin would have had a bigger impact on gold. So I was wrong about that. But that's the reason. It's more of a market history thing for me than anything. And the people who own it, I understand it, but I personally could never wrap my head around it.
Fair.
Anything to add?
Um, I mean, it's such a big conversation. It's like I feel like you could spend an hour on this. There's a great book, The History of Gold or The Power of Gold by Peter Bernstein. Yeah,
Oh yeah, that's
gold
right.
is an interesting
And it's been around for
unique.
thousands of years too, so that could be part of it.
I guess the only yeah. Listen, I mostly agree with you. I don't own gold either. We don't know if our clients. So we're on the same page. The thing that it's like again, the decade of the '80s, you really have to take with a grain of salt because that happened after one of the greatest runs of all time, right?
Right.
So I think it's more fair to look at like maybe rolling returns or how it diversifies the 60-40 portfolio. Do you need gold? Obviously, we don't think so. Do I wish we owned gold this year? Absolutely. Um, I guess like anything else, I would say that know why you own it. If you didn't own it now, is now the best time to really dive in? I mean,
I think
probably not.
that's the point. But I think there's always going to be something that you go, man, I wish I owned that. Or Verdad Capital did this really cool chart where they show the U.S. equity market in a 60-40 portfolio going back to 1975, and they look at what was the diversifying asset, and you see these colors how it changes. So it's in some instances it was international equities and REITs and gold and factors and fixed income and commodities, and it changes every 2 to 3 years. Where it's like this is the diversifying asset. Now you could say, listen, I'm going to own them all. And as someone who is a diversified investor, I like being widely diversified, but I also don't think that you can own everything. Remember following 2008 crisis in 2010s, everyone talked about how you need to own managed futures. And some people would say, listen, you have gold and managed futures and you'll be fine. Just do it trend following. But to me, that was like, I understand the appeal for managed futures. It just doesn't fit in my portfolio purview. And that's okay.
I mean, you
I think you
can
have to
own
be
it.
okay not owning everything.
Right. You can own everything. You definitely can. But if you do, depending on the wrapper in which you own it and the visibility in which you own it, there is a high degree of likelihood that at some point you're going to rip something out because it just doesn't work. Or I'm using air quotes, it hasn't worked over X period of time. And the more you expose yourself to different asset classes, the more likely you are, not everybody, but in general, the more likely you are to point to something and say, get rid of this piece of shit. It's not working. Why do I own it?
That's the thing. And the problem is you do that and then you add something else that just did well, and
Right.
then you're investing in the
100%.
rearview mirror. That's
One-
the problem. So
yeah,
yeah,
for
you
sure.
you just have to be comfortable with what you own and why you own it.
For sure.
I understand why people own gold. I just personally don't. That's all.
Yep.
Um,
Okay. Remember this chart? Mike Bird tweeted, who remember those Fed balance sheet S&P 500 charts? You don't see those so much anymore. And
Great
it
chart.
was, it's funny. Great chart. This was the thing. It was all liquidity, Fed-induced liquidity. And I'm not saying that wasn't part of the story because it absolutely was, but clearly it wasn't the whole story. And I mean, AI, my God, I can't not bring it back to that because it's true. Absent OpenAI and what they're doing in the arms race, maybe this chart, not maybe, this chart would have looked a lot different. It is highly possible that the S&P would have followed this chart and this relationship would have appeared to be rock solid.
Were you a Scooby-Doo watcher when you grew up?
Oh yeah.
Okay. So at the end of every episode, the bad guy would say, and he would tell his whole plan. He said, and I would have gotten away with it if it wasn't for those darn kids and that dog, right? That's the stock market of the U.S. economy. It's always the bad guy saying, I would have gotten away with it if ... It seems like there's always something, and eventually there won't be something.
Sometimes those cries are more valid than others, and I feel like this time it is valid. I think that absent OpenAI, the stock market would not have bottomed in October 2022, and we would be singing a different story.
Yeah, but my point is the U.S. economy, it's almost always something that saves us.
You're right. And speaking of October 2022, last week we spoke about the fun you have debating when a bear market started, when a bear market ended, when a bull market started. Well, it is unequivocally true that the market did bottom 3 years ago. And Yuri and Timmer wrote a piece on where we are, year 3 of the bull market. The bull turns 3. So this next segment is sponsored by Fidelity Trader Plus. They allow you to trade seamlessly across all your devices from anywhere. If you want to learn more, check out Fidelity Trader Plus. Let's look at some of Urian's charts in this note that he put out. So
some of the best charts in the game too.
He's does he have the crown?
I mean, they just look the best. I don't know how he does it, but and if you missed it, he was on Asset Compound with me a couple weeks ago. We just did a whole thing where we went through all of his charts.
Yeah, you know what?
It was fantastic.
You know what? I think you could crown him. He's certainly on the Mount Rushmore, but he's Yeah, he's the king of charts as far as I'm
And the
concerned.
good thing is that no one's charts look like his.
Yeah. All right. So the first chart that I want to pull out, he looks at cyclical bull markets, the median length, and he does them with dots. And the size of the dots represent the CAPE ratio over that period of time. I've never seen it broken down this way. So this chart also, it adjusts for inflation. So look at, like, for example, look at the 1978 cyclical bull market. Look how tiny those dots were.
Oh, okay.
Money, right? So
Yeah.
I think what stands out to me on this chart is this is right down the fairway, because there's another line, and you just go to the show notes to take a look at this if you're not watching the video. There's another line that shows like the average path or like a band, and this is following it to a T.
That's interesting. So we had a textbook bear market, like non-recessionary bear market, and this is now a textbook bull market coming out of it.
Here's another great one. So Urian says the first year of a bull market typically begins with PE expansion as price discounts and earnings recovery. And then in year 2, the baton gets passed to earnings growth as valuation compresses. Not this one. So take a look at this. I've never seen it broken down this way. So he has, he's showing the price from the low. He's showing the PE from the low. And then he's showing the earnings per share from the low. And the price, as we mentioned already, right down the fairway. PE on the higher side. And earnings growth pretty much steady as it goes, like right in the middle. Then the next chart shows this. And this is the key takeaway, at least for me. For as much as we talk about bubble, euphoria, expensive stocks, peak earnings, and maybe. Look at this. So Urian's chart shows the stock market on top, and on the lower pane, he shows the EPS growth and the PE year over year. The PE has only grown by 1% over the past 12 months. Only 1%. Not a lot of multiple expansion there. 11% earnings growth.
So yeah, this recent period has been almost all earnings driven and fundamentally driven, right? That's good.
And exactly what you want to see.
And it's not a huge spread either, right? It's pretty. There's a lot of huge spreads on this chart.
So look at what happened like in the rebound in November, in the spring and the summer of 2020. That was all multiple expansion. You had earnings shrinking, right? Obviously. And you had PEs supporting the entire rally.
Right. Which is because in 2022, the PE ratio dropped by a considerable amount.
And that was an interesting observation too. In 22, obviously multiples got crushed and earnings fell certainly, or they came off the highs, let's say. Another weird period in time. You know, everything's a weird period in time.
Yes. No, if you look at, just compress this to this decade, just look at, it's crazy. It's all over the map. And obviously that's the COVID and supply shock and inflation and all that stuff. If anything, the most normal part of the period is right now, right? The last 12 months or so.
Sure feels it.
Everything before that was crazy.
That was a JK. All right. Balchunas tweeted $1 trillion with 2.5 months to go. He's talking about ETF flows. Unbelievable. Unbelievable.
So look at the biggest flows. VOO, IVV, SGov, and VTI. And then IBIT, which is the Bitcoin. So 3 out of the 4 are just big stock market ETFs. And then short-term treasuries.
Keep asking this question. I don't know that there's an answer that's not very simple. Where's all this money coming from?
I mean, listen, part of it just has to be inflation, doesn't it? It is funny that 3 out of the top 4 of the S&P 500, but
no. I'm saying like the fund flows. Like, what is it merely earnings? Like American people are earning a lot of money and then putting it into the stock market?
So if we're looking at,
I'm sure that's obviously the biggest source of it. Like, but it just seems like so much money.
I would need to study this further, but how much of this could possibly be baby boomers retiring, rolling over 401ks into IRAs, and that money's going into ETFs, and money going into financial advisors?
You
need to see the other side of the equation with mutual funds to understand that.
Okay,
but
yeah, you know what?
Theory.
I'm going to say that's obvious. That is 100% happening.
That's probably part of it.
So is that 2/3 of the pie or maybe more?
Or I mean, think about our business. When we have people come to us who have individual stock holdings that they made a ton of money on. What do they want us to do with that? Diversify it
Yeah.
out of the concentrated position into funds or right. So I think that's probably part of it. It's not the whole thing. It's part of it though.
Well, hold on. Maybe 2/3 is underestimating it. It's earnings and it's that. What other pieces can there be?
Where the money's coming from? You tell me. Where else would it come from?
Right.
Can be just yeah.
Earnings and 401k stuff. All right. We cracked the code. Good stuff, Ben. This is a great one. Since 2020, the value of equities, who tweeted? Daily Chartberg. The value of equities held by households has risen 300% for households under 40, 542% for the final 50% of households, and 50% for the middle 40%, the 10 to 50% of households. This is via Citadel Rubner. This is a wonderful chart.
That's really good. This is really good.
So the value of equities held by the middle 40%. That is steady as it goes for the most part. Now, there was an inflection in 2020, but the under 40, this chart is worrisome. And I love that people are in the game. I love that they're speculating.
Wait. You're worried about this? I think this is fantastic news.
No. Worried, I don't know if that's the right word. Let's just say that I think that this one is the most susceptible to drop dramatically.
Okay, that's fair.
Because as a lot of these degen names, and I don't mean that disparagingly, I would assume that this is not cool to say, but listen, I'm sorry. I don't know what else to call it. A lot of these non-profitable names that have gone up and to the right, which is what this crowd owns, they are going to crash.
So I think my thesis is, and again, I think this is fantastic news that younger people are more represented by the stock market. This is great.
So do I. By the way, $3 trillion. That's a hell of a lot of money. Wow.
If you look historically, it takes a really bad period for young people to throw their hands and give up. So after the 70s, when the death of equities happened, it was young people who gave up. Older investors stayed invested. Young investors said, I'm out of here. After the 2008 crisis and we saw 50% crashes, it was young people and millennials that said, I'm done with the stock market forever. So I think it would take, especially since people are more diamond handsy these days and used to crashes, I think it would take an extended period and probably a financial crisis to get young people to say, all right, I give up. I'm tapping out.
100% concur. Can I take umbrage with something that I just said? Now, I've mentioned this in the past, but it's been a while. So for newer listeners, there's times that I say stuff on the show that I acknowledge sounds completely idiotic, and I'm about to do it, where I will listen back to something I said 2 days ago and said, whoa, nope, you're wrong. And it's me. I'm calling myself out. So we've got takes flying all over the place. So if you disagree with something that I said, there's probably a good chance that I would say, yeah, you're right. That was stupid. All right. So what do I disagree with myself 30 seconds ago about? This inflection point that you saw in 2020, I think that if you were to look at the aggregate holdings of this younger cohort, it most likely is dominated by the Mag 7 names. Okay? It is most likely dominated by the blue chippers.
There's probably more ETFs and index funds in here than most people realize.
Yeah. So it's not to say that those can't fall 50%. Of course they can. But the names that I was just referencing, the nuclear, the uranium, the quantum computing, all the names that are up 1,000% over the last 12 months, that's the names that I think are at some point going to crash. And I also think that that is probably a relatively small, let's call it less than 10% slice of the pie.
Right. Yeah. These people are the gamblers too. They're on the Reddit or they're on their sports stuff gambling. Like this is just, I don't think that crowd, it's going to take a really bad bear market to get that crowd.
Yeah. And now I also think that these people are smart. Like they know what they're doing. They know that the music is playing. Now there's some true believers who think that these companies are the future. And maybe they are. I mean,
they've jumped from the meme stocks of GameStop and AMC to these others, to AI stocks, to quantum computing, to like these people who are speculating this stuff. They've been jumping from idea to idea. They haven't been stuck in something.
Have been making a hell of a lot of money. So I don't begrudge. This is not shot and forward. If it doesn't crash, I would do great, wonderful.
Credit to you for saying that word correctly because it's always hard for me.
Yeah, no, I have no rooting interest for these people to lose money. I don't like when people lose money. All right, so at speculator_IO tweeted a list of these companies. It's called the $0 Club. And there's
wait, why is it $0? Because they don't make any money?
That's right, Ben. That's wild, huh? Forget about money losing companies. Like companies that like basically have little to no revenue. Like Serve Robotics is on here. We've joked about that because I think it's a name that Josh might have owned in the past. We were looking at their earnings report, and it was like $400,000 ARR. I mean, it's like a joke. It's like a
It
startup.
is funny that on this chart they list price to sales and price to earnings for everyone. It says NA.
And then it shows the year-to-date returns, and it's hilarious. I mean, absolutely a wild scene here.
So obviously I don't follow these degen stocks very closely. The market caps for these were pretty small to begin with, but now they're all like relatively large companies.
Yeah.
Like look at the size of the market caps on these things.
Yeah, dude, these are not small names.
They're not tiny anymore.
So what's the biggest name on here? AST Space Mobile. ASTS is the ticker. I will admit I am not familiar with this name. This is a young man's game, and I'm no longer a young man. That's $35 billion. Oklo is 25 billion. Rigetti is 18. QuantumScape is 10. Joby is 15.
Big companies now.
And listen, these allegedly are going to be the companies that change the world. So I'm hoping that they work. Okay, don't get it twisted. I am not looking to pound my chest if these names crash. I think everybody's consensus that these names will crash.
There's no way that a pasta is going to change the world. Rigetti Computing is never going to change the world. I'm willing to say that.
I'll also say, like, there is a reason that these stocks are doing what they're doing. And now there's always a reason. And it doesn't mean that it's not being taken 3,000 steps too far, but there's a reason. So Morgan Stanley has a national security index. Who tweeted this? I want to give this person credit. Dividend Talks. So 39 companies across 4 major industries worth watching. They're looking at nuclear energy and uranium, batteries and energy storage, rare earth and strategic metals, and lithium. And a lot of these names are in this list. And so if these are deemed to be national security type stocks and the government gets involved and puts them on our balance sheet, LOL, maybe the valuations might not make sense, but maybe they might be elevated for a reason.
So getting back to my Scooby-Doo analogy, with all this stuff you're seeing, like if this economic recovery or economic expansion continues in the years ahead, people are going to go, well, if it wasn't for robotics and if it wasn't for self-driving cars and if it wasn't for all this new energy sources, the economy and the stock market would have rolled over. That's going to be the story if this thing continues, right? They're going to like, it's kind of crazy to think people are debating the AI bubble, but we haven't even got the robotics side of things yet.
Yeah.
Like, I actually think, here's my take. I think if an AI bubble does burst, I think it will be a glorious, glorious buying opportunity because the AI stuff is going to work eventually. Robotics is coming along. Like you could, if there's a 20 to 30% bear market because the AI stuff gets too far ahead of itself, it is going to be an unbelievable buying opportunity for the years ahead.
I need a humanoid in my house that can do all sorts of tasks. One of them, electrician, plumber, cleaner, all this sort of stuff. I need somebody, I need a robot to look at my Wi-Fi connection and figure out what the hell is going on because I've had Verizon in here 3 times. And you know, these extenders, I used to have an Orbi at my old house. Now I've got these Eros. Are they just selling us shit because we buy it? I can't prove that it works. I can't even prove that it's on. I see a yellow light. It's not working.
Yeah, I use some Google ones. I agree. It's hard to tell if it really makes your Wi-Fi better or not.
I just feel like
I've got 2 or 3 of those throughout my house.
Is this not
I really don't know.
This is the American consumer. Oh, an extender. Yeah, I need that. Yeah, extend. Doesn't work.
That is true. I don't know. But think about, I've said this before, all the baby boomers in the years ahead, when they get to old age and need to be helped, like we're literally going to need robots to help take care of them in old age because they're never going to leave their house. Right? Like millennials are too selfish to take care of them. Sorry, millennials, it's true.
Yeah.
We're going to need robots to help take care of people. All right. Here's this is worrisome to me. 1 million people tweeted this out. ETF Tracker says this. There's 13 new 5 times single stock ETFs that were just filed with the SEC. AMD and Amazon and Coin and Google and Strategy and Nvidia and Palantir and Tesla and all the companies that you know.
And Ether. Wait, so what happens on the day that Ether had a 30% drawdown? Does this 5 times leverage? Do you owe this company? Do you owe the stock exchange money? How does this work?
I mean, 1 million people made this joke, but this is the Onion headline of Gillette saying, "F it, we're doing 5 blades," which they did eventually. But come on, what are we doing here? This is this is the kind of thing to me that is going to lead to a flash crash someday. Like there's taking stuff too far.
Yeah. Um. Yeah. This is crazy talk. I also don't know how much I'm bothered by it. I would want somebody. I would want like Nodic to say like, dude, this is the type of stuff, to Ben's point, that does flash crash the system. Because in a vacuum, I don't give a shit about people gambling, because that's clearly what this is, right? And
Yeah.
that's like obviously the world that we live in. And so to each
And there
their
will
own.
definitely be people that use these.
Now,
Of
if
course.
this poses like market structure risk, then ban it immediately. To that point, Dave Dondick does weigh in here, and he says, if I was making odds here, I suspect that these will be nixed by the SEC staff as soon as they come back to work and clear off their desks. There's a government shutdown. Dave says, but that's part of the strategy. Thanks to the ETF Rule 6C11 and recent generic listing standards, as crazy as these filings may seem, they are actually, quote, normal, and thus if the SEC doesn't explicitly kibosh them, they go live in 75 days. If this shutdown drags into the end of the year, a whole lot of products are just going to appear without a weather eye, and it will all come down to how conservative velocity. All right, whatever. This is crazy town. So if their strategy is to sneak it through while the government is shut down, and I guess from a business point of view, kudos to them, right? Like, they're doing business and this is business. But my goodness, if this is where we are, this is, yeah.
I don't. I don't love it. I get it. People are going to do what they want, and the pendulum obviously just keeps swinging. I just, if we're going to get the deregulation, can we please make it in places where it matters, especially the housing market? Just like, is the deregulation really just going to be we're going to let people blow themselves up with these different strategies?
Yeah.
Let's make it easier to build houses. Come on, what are we doing here?
All right, there was a article in the journal, China betting it can win a trade war, is playing hardball with Trump. Last week, Beijing imposed sweeping restrictions on the export of rare earth minerals, which are vital to consumer electronics and the tech industry. Trump then threatened additional 100% tariffs on China. All right, so China knows what they're doing, right? They're trying to mess with our stock market. They know that Trump is going to cave. I mean, they have seen this movie before, and they do know how it ends.
It's now Taco Day. It's not just Taco Tuesday. It's Taco 7 days a week.
Yeah. And speaking of China, I just want to make one thing. Last week we spoke about Beijing versus the United States, the book Breakneck, who's going to win. And when I said those people about China, just to be very clear, I don't mean the Chinese people. I mean the government. Right? I'm not disparaging a whole nation.
Because they control everything. Yeah.
Yeah, I'm not disparaging a nation of 3 billion people. I'm talking about the government specifically. And then
no, you don't have to say that. Cancel culture's over.
Fine. So I also wish that, so I didn't finish listening to the book while we were having that conversation. And towards the end, they were talking about like people defecting and leaving China and not thrilled with what's going on. And I would like to amend my answer of last week. Like, oh, they're a tough opponent and who knows how it's going to play out. Who knows what's going to win. They are a very tough opponent. And yes, who knows how it's going to play out.
Yeah, that was interesting. He basically saying a lot of the people who are well-to-do and not well-to-do in China are saying, I can't take this. I'm out of here.
Yeah. So it's not like black or white where there's going to be, okay, here's the winner, here's the loser. Like it's obviously shades of gray and everything else. But we're going to win. Like how could you just not believe in freedom and human rights versus a centralized authoritative decision maker that gets to do whatever they want to their people? Like, so answer amended. We're going to win to the extent that there.
Here's the thing, though. I have faith in the U.S. system as well, but in something like this, in a trade war, they can take pain way more than we can. So in a trade war, I would put my money on them. Like,
because they don't give a shit. They don't care about their citizens and the livelihoods of their people the way that we do. Some of the stuff that's described in the book is truly horrific shit, and the ability for them to tolerate pain on their society is next level compared to ours. We cave as we should.
Yeah. So the fact that we did cave and it's better late than never, I guess. But if you, after reading that, and you and I are still macro tourists, but now I think we consider ourselves like 20% China experts. If you read that book or listen to the book, you realize like we never had a chance in this trade war against them. The way that they produce products and how far ahead of they are.
Probably laughing.
Yes, they've been laughing this whole time. So the Wall Street Journal says the U.S. is tiptoeing away from many of Trump's signature tariffs. Apparently, they're exempting a lot of the products because they're goods that we can't make in the U.S. and can't produce in the U.S. And of course, this makes it. But at this point, then we should just probably take them all back and just like let's chill here, because it does seem like it's all small businesses that are the ones that are dealing with the pain here. The large businesses have the margins. If they're dealing with, they're fine. That's why the stock market hasn't cared as much. 'Cause someone asked, I think my dad asked me a couple weeks ago. He said, "Man, I guess I was totally wrong about these tariffs because I thought for sure it was going to sink the economy and the stock market if you just look historically at how bad tariffs can be." And I told him, like, no, you don't get it. They went back on all the biggest stuff that impacted the biggest parts of the economy in the market. That's why it's still having an impact, just in different ways.
Totally. And when I say totally, I have to admit I wasn't listening. I was typing. I apologize. That was rude. But I did have to send something.
That's okay. The over under for parlay on how many times Michael's going to ignore Ben for this episode is set at 4.5.
Oh, under. That's one time.
All right, that's at least 2. All right. So there's this chart from the Financial Times showing the most heavily shorted U.S. stocks have raced higher this year, and it shows the most shorted stocks since 2020 versus average U.S. equity returns. And so this is the top 250 stocks that are in a heavily shorted basket with a market cap above 200 million.
That Jesse
and it
Livermore
has
quote.
it has not just outperformed recently; it has literally outperformed the entire decade. Now it's raced way higher recently. Now I have 2 ways of looking at this chart. Okay, one is, man, this stuff is out of control. This is insane, like speculative, whatever. The second way to look at this is, why are hedge funds so bad at shorting stocks?
Well, there's a third way. There's a third way.
Okay.
So the first one is, what was the first one?
This is a speculative.
Okay.
This is crazy.
Yes,
it's
that's
so
right.
speculative, and oh my
All right.
gosh, this is out of control.
Yes. Why are hedge funds so bad at shorting? I know they're so bad at shorting. I think it's
But obviously they did not learn their lesson from the GameStop fiasco.
Correct.
That's surprising to me.
All right. So it's a combination of speculation unleashed on society and in trading apps, the likes of which we've never seen. Right? Bucket shops.
This chart shows Reddit won.
Bucket shops made it very difficult to speculate. And even in the 60s, right, when these brokerages got just literally they couldn't fill all the orders. Remember that? What was that book? The Go-Go Years, Once in Gold Con. I don't know.
Yeah.
One of the John Brooks books.
Yeah, Go-Go Years.
Okay. The other part of this potion is in a technological revolution like we're in right now. The money-losing companies that people would short and say these aren't real businesses, they get the benefit of the doubt because you are in a believe everything bull market.
Yeah.
Right?
So it's funny though.
So all of these names, like, yeah, this is a speculative bull market with new technologies. The companies aren't making money because they don't need to, right? Like they're not there yet. It's like that thing it's in Silicon Valley. No. Revenue is the worst. Don't show any revenue.
So it's funny though, because I tweeted about this and I gave my 2 things, like saying 1, speculation is out of control, 2, hedge funds are terrible at shorting. And Jim Chanos, a famed short seller, replied to me and said, even another way to put it, despite clear outperformance from such stocks, long-only managers still generally underperform the market. And it's like everyone loses. But the thing is, this decade is literally the only people winning are retail.
Yeah.
Like retail degen traders or retail just, I'm going to buy what I know. Those are the only people outperforming the market.
As somebody who is not on the other side of those people, you love to see it. Now, I can't imagine the frustration from the professional investors.
Fundamental head. Yeah. I'm guessing like a David Einhorn or something like that would look at the balance sheets of these and go,
I can't imagine the pain of this doesn't make sense. I've seen this movie before. I can't imagine what that is like to live through. And I'm happy that I don't.
Short selling stocks, you have to be wired differently. I would never be wired to try to short anything.
Oh no, I'm a sheep. I can't take the pain of people being mean.
All right. This is interesting. Let's talk about crypto. This is from Kelshi. They have a bet. Will Bitcoin be above $200,000 by 2027? And I think does it hit that at any point in the year? Which is not that far away. And it's essentially it's like 53% say yes, above 200,000 by 2027.
I feel like that's exactly where the odds should be. It feels like a coin toss.
Really? Like a double essentially in the next
2 years?
Year and a half, 2 years?
Yeah.
You think that should be a 50-50 proposition?
I mean,
those odds seem way too high for a double.
Okay, then bet no.
All right. I think
I mean, if this
I,
is if it's free money, Ben, pick it up.
all right. Obviously, it's not free money because there is the tail.
Oh, there's that Grand Rapids hedge right there.
Yes, but that I'm sorry, that number should be 25%.
Okay, then that's grossly mispriced, and you should pick up those dollars.
Yes, I think I will. How's
Okay.
that sound? No, I don't do these prediction markets. Come on, I'm a degenerate. All right, let's talk housing for a second. You just bought a house, so this has nothing to do with your purchase, but I think it'd be really hard to be bullish and or positive on the housing market right now for a number of reasons. Here's some charts from Redfin. The homes sit on the market a lot longer, so this is median days on the market has gone from like 20 to 50, which is a lot. It's going up and to the right. Shares, most houses are selling for under list price these days. The median down payment obviously has hit a record high. This is kind of crazy. So it's $70,000 on a median home these days. This is surprising to me though. Where's the chart? Oh, I didn't put it in here, but they show that the average down payment is still roughly 20%. I'm surprised people or the median down payment. I'm surprised people haven't lowered that. But listen to this. So it seems to me like it's just the people it's a shrinking group of people who can be the buyers. And you mentioned this. You said like, listen, we had like one or two people check the house out essentially, right? It was a small pool
We
of
had two
buyers.
offers.
So this is from a Redfin article. With the housing market in a downturn, the people who are buying are those who are financially comfortable, secure in their jobs, and have money ready and waiting in the bank for a down payment, said this guy who's a agent in Austin, Texas. For example, a few months ago, I helped a buyer close on an $800,000 home with a 50% down payment. They were able to liquidate stocks to make a $400,000 down payment without thinking too much about it, and now their monthly payments are lower. That's the wealth effect right there.
Yeah. Austin is one of the worst areas of the housing market right now.
Yes. Texas and Florida sound like they're in a kind of a world of pain. And I don't know, I'm starting to think like the people have decided like, listen, the prices are just too high in a lot of areas. And I'm just going to sit out.
Okay. I am on the other side of this. I don't think it's hard to be bullish about housing. I think that
what's your bull case?
Rates continue to come down. No, that's it. I think it's a whole kit and caboodle. I don't think it's a down payment per se. I think it's the monthly payment. It's just crushing people.
I feel like I've been on that corner for a while now, and I'm wondering if the level of rates is lower than we assume to get people to really, because rates have been falling this year.
I think we're right there. Like I think that like once we get to 5 and a little bit under, I think housing activity can explode.
All right. I've had that same feeling for years now. I'm starting to like backtrack on it a little bit.
I don't know that I'm saying that prices are going to explode higher, but I think that activity is going to, I think activity could moon. I still think that there's a lot of people, I don't think people stopped wanting to be in a house. I think it just became completely unaffordable.
Well, I also think that
go ahead.
The difference between buying and renting in some places is so wide now that I think a lot of people just said, fine, I'll just keep renting. It's not worth it.
Yeah. Well, that is definitely what happened.
All right. Cool chart from, we talk about this all the time. Like, am I rich? Well, tell me where you live. Right. Flowing Data has this cool chart where they broke out housing costs by state. And it's, are you paying more or less than the national average? Right. And it looks like Alaska and Delaware are right at the national average. Of course, places like Washington, D.C., California, New Jersey, these places are way above. So California is 60% higher than the national average for housing costs. But it's funny that there are more states that are below the national average than are above it. So the places that are really expensive, California and Hawaii and these places, they pull up the average a lot. It's a huge, huge difference.
Yeah, it's really good stuff.
Yeah. Anyway.
All right, let's do some quarter stuff. I keep saying this. I do love hearing from the companies. And we've had people say like, Michael, you keep saying the CEOs won't lie. What are you talking about? All right. I think what I'm saying is
that's a fair pushback.
Totally. So let me be clear. If they are forced to report every 90 days, the ability for them to hide parts of the story that they don't want you to hear goes up dramatically. Because if you give them 180 days, they can maybe think that they could figure it out. That's human nature. Don't tell anybody. We'll figure it out. If you report every 90 days and there's cockroaches and you don't tell shareholders, you're out. Your stock will get crushed. The board of directors will remove you from the position if you lie to your investors so blatantly. So are there a million examples of that happening? Yes, there are. Absolutely. And I think that if you were to remove the 90-day increments, that would only happen with an increasing amount.
I agree. The level of analysts looking into things and asking questions.
They'd kill you. So I only mean that that CEOs are incentivized to tell the truth only because everything's public. That's all I'm saying. If they could lie, oh yes, they would. Absolutely.
And obviously, there still will be cases of fraud, but it's got to be so much harder today than it was in the past.
Yeah.
To really fool people.
Yeah. So all right, Amex. Amex is in the absolute sweet spot of this K-shaped economy. They are a premium product for premium spenders, and they are killing it. So their total billed business, it's 6%, 8%, 6%, 7%, 8%. That's year-over-year growth. And these are not small numbers. And goods and services and travel and entertainment up 9% and 8% respectively in the recent quarter. Here's the chart that we share every year, every quarter, and it just continues to blow the face right off my body. Look at the year-over-year growth of the younger people. Gen Z is 39% growth. Millennials growing 12% versus baby boomers are only growing 4%. And if you look at a percentage of the total, Gen Z is only 6% with 39% growth. That will continue to creep up, the percent of the total. But look at millennials, dude. Millennials are 30% of total spending, higher than baby boomers. How about that? How crazy is this? Millennials are spending more at Amex than baby boomers.
Huh.
Yeah.
That is surprising. So a lot of people would say this is bad news, but
bad news? What's the bad news?
That people are spending more on credit, but
no. Amex is not a credit card. Amex is a charge card, and you pay this shit. Amex, right. People are not relying on their Amex to make ends meet. That is not what's happening. And to that point, their credit metrics, no change. Percentage of card member loans and receivables that are 30 days past due, 1.3% for the last 5 quarters. These are, now again, does this speak to the entire economy? No, these are premium spenders. But net write-offs too, there's nothing here. People with money are continuing to spend money. But look at their net card fees, Ben. Look at the next chart.
Yeah, I know because I pay them.
So it was $1 billion in Q3 2019, and now it's $2.6 billion.
I wonder how much of that is the annual payments.
That's what this is. That's what this is. That's
by the way, speaking of credit cards, this is another one that was. Do you remember how many news stories there were about when the U.S. credit card debt hit $1 trillion? Oh my gosh, $1 trillion in credit card debt.
What's it now?
1.2 trillion. It's at 1.2. This is from YCharts as of Q2 2025. And guess what? I actually view the increase in credit as, for most people, like you say, it's probably a positive because they're feeling good and they're okay. And you're right, most of them pay it back off, so it doesn't matter that much.
Right.
It's an expansion of the pie.
Right. All right. So let's talk about Bank of America, a company that serves more or less Main Street America. Right. Bank of America. All right. Look at their asset quality, net charge-offs, and their net charge-off ratio. Is this going higher or lower, Ben?
It's falling.
Total net charge-offs of $1.4 billion decreased by $158 million from the second quarter.
Look how tiny the percentage is.
It's nothing. Provision for credit losses also down. And if you look into consumer net charge-offs and you look at credit cards, falling, Ben. In the first quarter of the year, it was 98 basis points, down to 90, now down to 82. I'm sorry. I know that there are people struggling. Broken horse here. There always are. But
you say broken horse?
Broken horse, what a dead horse, beating the dead horse, broken wheel?
You just put broken
arrow,
record
broken arrow. Broken arrow. That's what I meant to say.
I think you combine broken record with being a dead horse.
Nope.
So wait a minute. I can't remember. We do so many podcasts. Sometimes they all merge together. But you asked someone a few weeks ago, like, if you had one indicator in a few years to know if you're right or wrong, what would it be? And I feel like for you, credit card companies, that's your indicator. I feel like if
this is it, I don't care about the stories in the journal that are interviewing random people. Show me the data.
Right. We found this one person who is struggling because they have a low income. Of course you did. There's a lot of them.
Show me the data. And matter of fact, somebody sent us a video that I watched. It was on PBS about the K-shaped economy. And it's sad as shit. Hearing these personal stories from people, like on an individual person basis, it's horrible. I hate that there are people struggling. That's not unique to today. There are always. But if you look at the aggregate data, it is not showing what they want you to believe.
So I just put the finishing touches on my new book. I'm handing in the edits this week. It's done. Going away. It's going to come out in the spring. Um, and I write about the Great Depression a little bit in there. And even after the Roaring '20s, which is like one of the biggest booms for retail households ever. Like they got all these fancy new things in their houses, and they borrowed on credit for the first time. By 1929, at the peak, after the great decade, it was one of the better decades we'd had at that point. 60% of U.S. households were below the poverty line.
Wow.
So like no one had any money. And so it's like people point to these things, and obviously it is sad, but it's an improvement in the past, which is hard to wrap your mind around sometimes.
Yeah. Speaking of the past, one of the books that I'm listening to, I'll talk about it maybe next week when I finish it. Historical records, all these historical books, you mentioned the 1929, you know where a lot of the qualitative, the good stuff comes from? It all comes from diaries.
Right. Yes. People kept track of stuff.
Right?
Well, that's what
my grandfather had a diary. We found them when he died. And reading them was actually pretty brutal.
Yeah, you know what our diary is called? Twitter.
Yeah. Prior generations did not have easy lives.
Your like great grandchildren are gonna be like, wait, my great grandfather created this pie chart.
Yeah, he was just shit posting all. well, for a period he was, and then he grew up.
But I mean, the Hamilton one, all of it's based on letters they wrote to people. Yeah, it is kind of crazy. That's how people, because they had nothing else to do. What else are you going to do besides write a letter at night by candlelight?
You know how
TV.
You know how
people had nothing to do.
Bill Simmons always talks about like future generations are going to think Karl Malone was the greatest power forward of all time, and that's why he created this sort of line in the sand arbitrary metric that cuts off Karl Malone. I wonder if future generations are just going to like look at headlines as the arbiter of truth. Like they're going to look at Google searches and newspaper articles as if that represented the reality of what was happening.
I think history is going to be rewritten a million times because there are so many opinions now. I think in the future, people are going to be able to look back and pick and choose, and they're going to be able to create the history that they want. And so history is going to be very hard to discern going forward.
It'll be a choose your own adventure. Speaking of that, I had this really dumb, obvious, not profound thought the other day about, because Kobe is reading Goosebumps. I told him to see if those books were still around. So he got one of the ones, and I was like, oh man, I remember this from my childhood. Yeah, books don't disappear, obviously, right? We're reading books that are hundreds of years old still. And I was like, oh wow, Goosebumps is still around? Yeah, of course it's still around.
No way.
Yeah. All right, this is a tweet on the internet from boringbiz_. People wildly underestimate how hard it is to be wealthy. The bull market has cooked everyone's brain, and reality is that most people will not come out wealthy on the other side. Many will be stuck as their paper wealth evaporates. Being sustainably wealthy is grueling, requires years of hard work and building up skills and relationships. The people trying to tell you that you can side hustle or day trade your way to wealth are selling a complete lie. I agree with most of this. I fully agree with that last sentence.
Mm-hmm.
I think that most people will not come out wealthy on the other side. Depends what the other side looks like. So you could quibble with that maybe on where the market is in a couple of years, but the people trying to tell you that you could side hustle or day trade your way to wealth are selling a complete lie. Amen, brother.
I agree with that. I actually think I disagree with the first part of it, though. I think it's never been easier to be wealthy than in the past. We talk about the Vanderbilt stuff and them squandering it all. That would never happen today. I think there are so many experts and advisors and consultants and lawyers these days. If you're an extremely wealthy person, it's never been easier to hold on your wealth.
Yeah. Yeah, fair. I guess he's probably talking to like the self-directed young men that are 23 that think that like they are going to be wealthy for the next forever and ever. And I think for that cohort, yeah, he's right.
Yes, right. And yeah, the paper wealth thing, it's true. It's not real until you make the sale, right?
Yeah.
On the other side, though, you can say like, listen, if I don't sell, I don't lock in the loss, right?
Die with zero. Am I right?
All right. This is not. Speaking of wealth, our colleague Patrick Haley shared this. I think it was a Boston Globe article. talking about how to deal with like cognitive decline as you get older and health problems, and how are the baby boomers going to deal with this. And they show this chart that shows wealth and death gap of U.S. adults over 60, and it breaks it down by people over 60 and what part of the wealth cohort they're in. And so the top 10%, the death rate is 11%, and the average age of death is 85. If you go down to the bottom 60, 80%, the death rate is closer to 20%, and the average age of death is 79. So as you go lower down the income scale or the wealth scale, the death rate increases and the average age of death is earlier. This is a crazy chart, is it not? This is nuts.
Yeah. Also, the numbers are startling, but also what you would probably expect. No.
I guess I just didn't expect the gap to be that large, and so the bottom 80 to 100%, the average age of death is 76. If you go up to the top 10%, the average age of death is 85.
Yeah.
9-year difference. That's crazy.
It is.
All right, we got to talk about $50,000 cars. This is just my beat, I guess, because a million people sent me this story about how the average price of a car is now $50,000 according to Kelley Blue Book. Adding to the sticker shock, more than 60 models had average prices of more than $75,000. Insane. How much of this is attributable to inflation, which is obviously big, and I think the average price of a new car is up 25% since the beginning of the decade, right? And then we have all these new sensors on the cars and the cameras, and so like the Apple CarPlay, the screens, there's more stuff in them. So in that sense, it makes sense cars would be more expensive. But how much of this is also just people buying trucks and SUVs as opposed to sedans? Like, I'd love to know what percentage of that increase is because of that. It's got to be a big part of it. I suppose you can still get an Accord for, I don't know, 35, 38, something.
So Arbor Data and Science wrote about this. They write the average age of the U.S. passenger cars on the road up until the right since 1995 was 8.4 years. Now it's 14.5 years. They also say that the Toyota Camry, the best-selling car in the U.S., is more affordable than ever. They show it adjusted for the median hourly wage. It used to take 1,600 hours. Now it only takes 1,000 hours. So
that's it. That's very interesting.
But here's the other thing that I was thinking about. Yeah, 50,000 for the average car does sound nuts. I think that a lot of the SUVs are pulling this up, and maybe some of the high-end cars are pulling this up.
Yeah, it said the luxury vehicles definitely are pulling it up.
All right, but think about it this way. Because cars are on the road longer than they ever have been, because cars have so many more pieces of technology and gadgets and are more durable, it's sort of like the stock market. Like, yeah, the multiple is higher. It should be higher.
Right.
It's better companies. Is it not the same exact thing with the cars?
Right. The
technology now, notwithstanding the piece of shit that I drive. But, and speaking of pieces of shit, so my car is, my lease on my Wrangler Hybrid is up in April. So I called my broker or texted him and said, "Hey, Steve, I'm like 6 months out. Can I get out of this now? Like the summer's over. I'm not going to take the roof down. I want to get out." He goes, "Maybe. What's your VIN number and how many miles you got?" He goes, "Nope, you're 10,000 underwater." He goes, you're paying the lease off and then you get a new car.
All right. Not to throw shade here. Is it time to fire your car broker? Because every time you get a new car, you're underwater like immediately.
No, this
by an insane amount of money.
This had nothing to do with him. All right, on the other
Duncan sends us that a new Accord starting MSRP is $28,295. There you go. So you drive a car long. If this concerns you, you drive a car longer, or you get a sedan, or so like there are ways around this. If that number is sticker shock is so big for you, but I'm guessing most people will just say, "Screw it, I'm taking an 84-month loan now. I don't care."
Okay,
that's where probably most people land.
Other part of the car story is headline from Bloomberg: underwater car loans hit 4-year high and new signs of distress. Just over 28% of trade-ins toward new car purchases carried negative equity, the highest level since the first quarter of 2021, according to the amount owed on those so-called underwater loans was $6,900. Not nice in the latest quarter. I think that a lot of this was supply chain COVID issues. I also think, hey, guess what? Headline writer, it's not even where it was in 2019. And was anybody writing about this story in 2019? Did anybody care about underwater cars in 2019? Nope.
Yeah, aren't most cars underwater by definition? You drive it off the lot and it's 20% less than when you had it
exactly,
on the lot, right?
Ben. It's not even where it was in 2019.
Right.
But
Yeah,
yet
so in
here we
2019,
are.
it was 34%.
Yet here we are, and I'm not mad at journalists. I know I've been like hard on them. Like this is the business, okay? And we all do what is
You're
best
right.
for our
No
business.
one was talking about this in
It
2019.
wasn't a story at all. Nobody gave a shit. And in fact, getting back to why I enjoy listening to the company call so much, Ally, kind of exposed to the auto market. So Sanjay Sakrani, an analyst, asked, okay, obviously lots of jitters around some of the cracks that we've seen in subprime auto and just broader consumer credit trends, Michael. It seems like your metrics don't necessarily suggest a lot of that. Okay, so the CEO said, I appreciate there's a lot of macro uncertainty in the environment, but we're not seeing that impact our credit performance. And so we feel good about where we are, what we're seeing right now. Credit performance, data, okay? Look at the net charge-offs. Do you see anything there? Is it going up and to the right or is it going down to the right? Look at the delinquencies, Ben. Is it going up or is it going down? This is one of the biggest subprime lenders in the world. No?
Just wait. Hasn't happened yet. It's going
Sure.
to happen.
So, okay. I saw this morning on Instagram an image of somebody who looked a lot like Rocky on the beach running with the dog from Rocky. And it said, oh, I play Rocky. And it said, nope, no. We're not doing this. We are not doing this. I don't want a remake of Rocky. No, hard no. And good news. It's not a remake. It's the making of Sylvester Stallone making Rocky. And that I'm in for.
What documentary? Okay.
Yeah.
All right.
That I'm in for. All right, Daniel tweeted, I can't believe it's been 2 years since we brought in audiobooks premium to Spotify. Audio listening hours up 37% year over year.
It does feel like I've unlocked a new form of learning in my life with Audible.
How
It
good?
really
It feels good.
Yeah, it does. It feels so much better than listening to most podcasts. A lot of the garbage I listen to. I still have some garbage that I listen to because
I listen to Sean and Chris talk about the best horror movies of 2025, and I loved it, and I do love it. But it feels nice to mix in a little bit of education every now and then. All right, two quick things. I know we're running long here. Sorry, Duncan and team. So I got the house that I bought. There's a bar in the basement area, and we don't really have like a place for the kids to play. There's no that is the basement. There's no up, So
The great thing is eventually the kids graduate from play areas.
Yeah.
We took the play area and gutted it and turned it into a media room.
Yeah.
Didn't need it anymore.
Yeah. I can't wait to get there because I'm going the other way right now. So there's a bar in the middle of the room, and I love it because I love alcohol and I love the look of it, and I want it to be my bar, but it's not my bar. We're getting rid of it. So all right, whatever.
No, you're getting rid of your bar?
I'm getting rid of it.
Oh, tell Robin to call me. You can't get rid of the bar. Sorry.
I lost this battle. So we got two quotes. One of the people we know is a little bit more expensive, and the other guy just wasn't getting back to us. So I'm like, all right, well, go with this person. It seems like, I guess, sort of reasonable. $5,500 was the quote that he gave us to get rid of the bar and clean it up and paint it, whatever. And then the other guy just got back to us this morning, $1,800. And I said, well, shit, because we just gave the other guy $2,000 deposit. And so I went to ChatGPT and I copied and pasted, and I said, tell me the difference between these two contractors. Why is there such a discrepancy in the prices? One promising to deliver anything more than the other person is. And it worked amazing. It was perfect. The output was freaking perfect. So anyway, now I got to call this guy and be like, dude, I need my money back, or you got to lower your price dramatically.
Oh, so it didn't say like this other guy is ripping you off?
He was, the higher price is 2.5 times. It's $1,800 versus $5,500.
Right. That's a big deal.
It's a big difference. So, all right, I'll let you know how that goes. I'm a little bit nervous to be like, hey, I need my money back, but I'm going to do it. All right. Ben, you would just say, it's fine, keep my money, right?
No way.
All right, I am done with
Not
pumpkin
that
farms. I'm done with pumpkin farms. I'm just done.
Oh, thank you. It's they get bigger and grander every year, don't they?
It's just enough. Towards the end, I'm yelling at Rob. I'm like, just take the pumpkins. I'm done. I want to go home.
And then everyone's got to take the Instagram pictures
And
next
then
to the whatever.
She's 100 feet behind me. I'm online. There's people that are now behind me online. And now I have to let them go in front of me because Robin's not coming. She's with the kids. And I'm like letting people go. And then I just get off the line and I'm mad. I'm like, screaming. She goes, you sound like a crazy person. I'm like, yeah, I want to go. Been here for long enough.
I hate those places too. Kids, but here's the thing. We've been so busy with kids sports. We just realized this morning, my kids go, wait, we don't have pumpkins yet. And my wife going, oh my gosh.
You know what
we have
pumpkins
family
yet?
pictures.
Good for you. I'm jealous.
And we just realized that we have no time to go to a pumpkin farm. And I'm going, yes.
It's awesome.
Yes. I'll get them at the grocery store. Don't worry. Who cares?
Yeah, not me.
We're going to throw them out anyway. All right. Before recommendations, real quick. Paul Warner on Blue Sky said, looking to differentiate a new system, Haloid, which is the original name of Xerox, hired a Greek scholar at Ohio State University and coined the term xerography from 2 Greek roots meaning dry writing. Haloid changed its name to Haloid Xerox in 1958, then Xerox in 1961. So they literally did make up a word. Xerography wasn't a thing.
Huh. Good for them.
Yeah. All right. Recommendations. I got a lot this week.
God.
I watched I Like Me, the John Candy doc on Amazon Prime. And John Candy was my guy.
Yeah.
Okay. I think Uncle Buck is one of the greatest movie characters of all time. It's one of my top 10 favorite movies. Planes, Trains, and Automobiles is obviously one of my favorite movies too. And it's so good. It's very sad too in a lot of ways at the end. But it's crazy how in the 70s there was a group of people that got together in Chicago and Toronto, and it was like Martin Short and Bill Murray and Harold Ramis and Catherine O'Hara and Dan Aykroyd and Eugenie Levy and John Candy, and all these people just happened to be coming up at the same time together. And it's kind of like one of those lightning in a bottle moments. But it was so good, and you got to see all the, like, how good of a guy he was and all the different parts he played, and everything he was in was good. Summer Rental and Great Outdoors, and he had the small parts in, Vacation and Home Alone, and I was a big John Candy guy. Love him. It was very, very good. I
want to watch it. I'm not as big on him as you are, but I love that you love him, and I want to watch it.
Uncle Buck is probably one of the movies I watched more than any other in my life, and I introduced it to my kids a couple weeks ago, and they loved it too.
Is there one in the woods that you mentioned with him and Dan Aykroyd, or is it just Dan Aykroyd?
No, that's him. That's him and Dan Aykroyd. The Great Outdoors.
Okay,
that's a great summer movie. Great. Dan Aykroyd plays the shooter guy from Chicago. Very, very.
No, it's so interesting. So because you're just a few years older than me, like your window of movies, of your childhood movies, is like fairly different than mine, at least on the early side. Like those 80s movies, like I just missed them by like a year or two.
Yeah, that makes sense. Like I remember seeing the preview for Home Alone and going, oh my gosh, is this Uncle Buck too? Because it was Macaulay Culkin. And realizing, oh, that's a kid from Uncle Buck. Okay, I also introduced my kids to Tremors this week.
Kevin Bacon classic?
Wait,
why Tremors? It's so random.
My son loves that kind of cheesy action stuff. Tremors was one of my movies too growing up. I don't know why. Tremors was just, I watched it anytime it was on USA, I watched that movie so many times. And my son watched it like 3 times last weekend. He loved it. And it's one of those movies that shouldn't work. It should be if it was made today, it would be way cheesier than it is. But I don't know, something about that movie. It's so good. And you being a horror guy, you should love that movie.
I like Tremors. It's so, kids don't know what it was like to watch a movie on USA. It's like, all right, this movie's 3 hours with commercials, and you're just gonna sit here.
Right, and the swear words are bleeped, and yeah. All right, one more. Another movie I watch all the time. It was on rewatchable, so I rewatched it again since it was Robert Redford month. Sneakers. You ever watched Sneakers before?
I never watched Sneakers, and I never saw The Natural.
Okay, my daughter and I sat down to watch The Natural this week too, and I said he's like Ohtani on the Dodgers basically in real life. But Sneakers is another one of those 90s movies that I watched all the time. My mom and I love that movie, and it's just a great like spy, and it feels a little dated now, but it's in the cast of that is Dan Aykroyd's in that as well. It's amazing cast in that movie. Great movie. And I think Robert Redford has people always talk about like James Earl Jones and Morgan Freeman. I think Robert Redford has one of the best voices ever.
Oh yeah?
How's that? He did the voiceover for River Runs Through It too. He's just got a great voice.
Did you finish Task?
We didn't do it yet. Okay. I was watching the Lions game last night.
Okay.
What do you think about the finale?
Great. So just HBO is just better than everything else. I mean, obviously. Ruffalo. Oh, so there was no spoiler. There was a scene at the end in the courtroom where Ruffalo just was amazing. Amazing acting.
The acting in that show is amazing.
The character Maeve, I thought, was the strongest.
She was good.
The dude who played Robbie, I forget his name, was excellent.
Yeah, he's the guy from he was in Ozark. Yeah, I think he's fantastic.
Yeah, it was a very good show, and I love because I even do think that episode 6 and 7 had quite a bit of fat in it, like more character stuff than I love. But I love those 7 episodes.
Yeah,
love
that. That's pretty. Yeah.
Okay. I almost forgot about this. I saw One Battle After Another.
Okay.
All right. It was a good movie. It was a very good movie. It didn't drag, even though it was very long. It wasn't like I didn't fall asleep. I wasn't bored. But and there's some great stuff in there, some really cool camera stuff that the film nerds love. And it was a good movie. It just was. It was at $170 million budget. Good movie. Wild. But people love PTA and I don't get it. And I don't want to be a hater because I liked the movie. I really did.
So it's like a 7 out of 10, maybe?
No, it's better than that. I would say like it's like a 7.4. Like it's a good movie. It is a good movie.
You're right. That's why I told you can't trust the film nerds anymore because they're blinded and they just say everything is the greatest thing they've ever seen.
The PTA adoration. Now I'm just a movie guy. I'm not a film guy, so I just don't get it.
Yeah, I'm with you.
All right, real quick. Let's run through this. It's Halloween season, so I did come up with my 10 favorite horror movies. Now, this is no particular order, and to be honest, I didn't spend a ton of time on this, so is this the definitive final list? No, but it's my list. And there's nothing obvious in here, okay? No Friday the 13th, no Halloween, no Scream, no Blair Witch, no The Ring. Like, I don't think there's any movies on this list. In fact, there are no movies on this list that did like $50 million at the box office. So nothing mainstream, okay? Here we go.
These look like names that you all could have just made up, and I wouldn't have known any better.
Now, I do love found footage. I love a good they just scared the bejesus out of me. Where it's either found footage or when they hold the recorder. Yeah, found footage, I guess. That's what it is. Deadstream was one of those. Host they did during the pandemic. It was a Zoom call with 5 teenagers and things went awry and that scared the hell out of me. Speaking of hell, Hell House LLC. Hell House LLC. Great one, Ben. I think you might like that one. All right, I saw this movie when it came out in 1995. I've spoken about this on the podcast before. What year was this? 94. Insane. My dad took me to see this when I was 9. And this movie gave me nightmares for months. My mom was very upset that I saw this. In the Mouth of Madness is a John Carpenter movie with Sam Neill. You ever hear of it?
No, it sounds like it could be a porno, though.
So the concept is Sam Neill is he an agent, a literary agent? I don't even know. But like this author, this famous horror author goes missing and they go to find him and then they get wrapped up and like he's writing the movie. It's very meta. Very good. All right, VHS. Similar to Hell House, well, there's multiple of them. VHS is also a found footage one. The most recent one is a Halloween version. There's probably 5 or 6 of them. Always slap. All right. And then the next few are demented. The Dark and the Wicked. The Dark and the Wicked is quite dreadful. Just hurts to watch. Borderline painful. Speak No Evil. Not the American version. Green Room. I don't know if Green Room is horror per se, but I don't know what other genre you would put it in.
Okay, I actually tried to watch that. I couldn't make it through it.
Very gnarly. I would say grisly. That's grisly.
Yeah.
Eden Lake, also a grisly movie. That is with Beth from Yellowstone. And lastly, perhaps the cake taker of demented films is When Evil Lurks. I think that was an Argentinian one, but I'm not 100% positive.
Okay.
And,
Green Room is the only one I've ever heard of here. Argentinian horror movie.
And well,
you said you're not a film guy. So here, I had a realization this weekend. We went to one of those horror things in the woods, right, at our local ski place, and it was a path you followed, and it was meant to scare you, right? And so we went with my daughter and her 2 friends. They're 11, and people would jump out, and the people dressed up were really, really spooky looking. It was very well done.
I don't like that. That's too much.
See, I wonder about like honestly, I had zero. My daughter's like, why are you laughing? I was laughing at it. What I was going through. Like, nothing scared me. It didn't do anything for me. And my daughter and her friends are freaking out, right? Because they're jumping out and they have cleavers.
I'd be terrified. I get very scared at horror movies.
So I think that's why you like, for whatever reason, the horror thing doesn't do anything. Like it doesn't bring about any emotions for me at all. And that's why I don't like these movies.
All right, you're not alone. I find it bizarre.
It's personal. Yeah. Anyway.
For me, there's oftentimes, in fact, I would say 90% of the time where I will either have to like mute it while I'm watching. Like I prefer to watch Halloween during the day because I get very, I close my eyes. I get scared, and maybe that's why I love it.
See, that's it. For whatever reason, it just doesn't hit me that way. So to each their own.
Okay, well, credit to you.
That's why there's a market.
You're a braver
All
man.
right. IDon'tShop.com. We have a brand new animal spirits mug for the fall for all those hot chocolates, coffee, tea, right? Very well done. Thanks to the production team as always. Duncan, Dan, John, Travis. Who else am I forgetting? Nicole, Rob, Graham. Appreciate you all.
Keith.
Email us, Keith, animalspirits@thecompoundnews.com, and we will see you next time.